Welcome, everyone. I'm Senior Trading Mentor Raj Malhotra, and today I will be covering what if genius fails again and again and again. So, the so-called genius I'm thinking about are the guys that call themselves the smartest guys in the room, which are bond traders, and more specifically, the bond vol traders. For my long history on Wall Street, bond traders have always thought of themselves as superior to equity guys. Bond traders are private school, equity guys are public school. They're Ivy League, we're state school. Bond traders were all about data, and they always thought equity guys were all about stories. Basically, they just thought they were smarter than us, so I enjoyed nothing more than a personal level than making bigger bonuses than some of those pricks. The problem with many intelligent traders, but unsuccessful ones, is they can only see quantitative information and often can't see the big picture. And I think that's what's going on here. So let's look at some facts of what the bond market, and more specifically, the bond vol market, is looking at. So the bond market is clearly telling you the stock market will go much lower. Hence, we will have rate cuts this year. There's been a downward sloping yield curve, which historically has been a clear signal of recession. But that's been priced in like this for about a year now. And that's why you've heard so many people going for recession over and over and over. The thing is, though, if equities hang around these levels and inflation hangs around these levels, to me, there's almost zero chance of a rate cut this year, in my opinion. I mean, Powell said it pretty clearly. In his last meeting, he said no Fed rate cuts are on the table this year for now. In fact, Powell has even signaled that he would err on the side of raising rates too much rather than ease. Kashkari reiterated the same thing this week. Now, getting too aggressive on rate hikes is a negative for stocks, no doubt, but I don't see how they pivot this fast, even if the stock market tanks, because that would admit a mistake by the Fed. And Powell knows he screwed up once by waiting too long to raise rates in the first place. I don't think he's going to pull a Britney Spears and say, oops, I did it again. I believe the Fed is going, in the next meeting, will signal a very hawkish pause, meaning they will pause, but they will not be talking about rate hikes in the future. In fact, they will not be talking about cuts, but they will reiterate they're looking more at hikes. So let's move on to the bond market volatility index that I look at, more specifically called the MOVE index, and compare that to what the VIX is telling us. So if you don't know, the MOVE index is often referred to as the VIX for bonds. Like the VIX is calculated from option prices and measures implied volatility of U.S. Treasury options across various maturities. On the other hand, the VIX is a volatility index derived from S&P 500 options for the next 30 days, and it's a measure of future expected stock market volatility. So here are a few facts about the MOVE index and the bond market as a whole. So the bond market is much larger than the stock market in both size, and it's truly the backbone of our financial system. Because of this, bonds are generally less volatile than stocks. The MOVE index and the VIX also generally move in sync, both up and down. And when bond vol is higher than equity vol, which it's been for a while, it means that there's an issue in the bond market, and that leads to bond markets often pulling stocks lower and sometimes much, much lower, like what happened in the Great Financial Crisis. As you can see here, during the regional bank crisis in the last few months, the MOVE got up to close to 200 on March 15th, which was its highest levels in 2 years. Now, the VIX did increase, but not nearly as much as the MOVE index. And stocks didn't actually go much lower. They did initially, but actually are higher now. And what happened was bond traders were short equities, got killed, and they're not happy about this. Remember, these bond market geniuses, as they think of themselves, they think they're a lot smarter than equity vol traders, and they're pissed because they lost money, and now they've resorted to blaming dumb equity investors. As you can see, as of we film this, the MOVE index is trading around 132, and the VIX is around 19. So what does that mean in historical levels? On a long-term average, the MOVE index is still very elevated versus the VIX. The average reading of the MOVE index since its inception is just over 100. So that means we are more than 30% above that level. The long-term average of the VIX is around 19, and that's where we are trading currently, even with all this debt ceiling uncertainty. And without that, I'm confident we would be much lower. So clearly someone has to be wrong here, and we know who it's been. See, if you look at what the VIX tells you, a VIX below 20 is viewed by the equity market as moderate risk, and that's long been considered bullish for equities. Last week, the VIX actually traded below 16 for the first time since November 2021 and hitting a one-year low. So even with a rebound in the past few days, it's still about 30. It's still down about 30% over the last year. The MOVE index, on the other hand, is right in the middle of its range, and while it's nowhere near its peak of 200, it's still up 25% over the last year. So you can see that divergence. No doubt there are risks in the equity market, and everyone's keenly aware of that. The S&P staying around these levels and grinding higher is absolutely driving the bond bears insane. So in summary, the MOVE index has been very negative, has been a negative indicator for stocks. So the consensus bond vol trade has been to be short the MOVE index and short equities, and we know how that's worked out. So what they're doing now is they're resorting to fear mongering to get you bearish stocks, but they've been doing so the same thing for the last 6 or 9 months and have just been plain wrong. They're essentially now telling you just ignore equity vol and focus on bond vol. We'll be right. They're just telling you to suck my VIX. A long-term trend of the S&P versus the VIX, or the S&P versus the MOVE index, is negatively correlated. That just means that when vol goes up, equities go down, or vice versa. Now, that's worked for the VIX in the last year if you look at this chart, but it hasn't worked for the MOVE index. So as we know, bond market traders have gotten crushed by this, and they're now at peak bearishness. One place to look at the bearishness is looking at positioning. So look at this chart here. This shows CFTC S&P 500 net positioning, and that's at its most bearish since 2011. So should the debt ceiling debate get resolved, which probably will, because one thing we know lawmakers can agree on in a bipartisan basis is they need their summer vacations. This could be just another way to squeeze these shorts. We could absolutely see a summer grind higher that will frustrate these bond traders and other shorts as they sip their spicy margaritas at Gurney's in the Hamptons. So if you look at data other than the MOVE index, there is no sign of an imminent recession. One model I look at, admittedly, with 1 month of data, which was in April, but that's predicting a GDP in Q2 of 2.9%, which is a far cry from a recession. Just look at more recent data. Look at this past weekend data. 2.65 million travelers went through TSA checkpoints on May 21st. That's the highest since November of 2019, which was summer of Thanksgiving pre-COVID. So travel is clearly showing no signs of slowing down. Housing was supposed to have crashed already, but it's still strong. In Fairfield County, where I grew up, every single house I can tell you that's worth around $1 million to $1.5 million is going for 10 to 20% over asking price. In a survey I saw last week, 65% of economists are saying they're expecting a recession in Q3. I don't know how you get to that number from the data I was just sharing. Last November, 50% of them were predicting a recession in the first half of 2023. So basically what they're saying is they're more confident of a recession today than 6 months ago, but they just keep pushing out the date of when the recession is going to happen. Remember, guys, a broken clock is right twice a day. If you say the same things over and over, odds are eventually you'll be right. And then these bozos can say, see, I was right. I mean, could this market come crashing down? Of course, and it probably will at some point, to some degree. But just pounding the table with the same tired narrative is just lame and pathetic. Admit you've been wrong and move forward. That's what good traders do. That is, if those guys still have any money left. You know, when you look at the pain trade, which is something I always look at, it is clearly higher. Demand will no doubt, in my mind, slow down later this year, but unless labor markets weaken significantly, which there's no evidence yet of that, a recession is unlikely in Q3, and if it is, it's certainly not going to be a deep one. The new narrative I'm hearing now is once this debt ceiling deal gets done, that's a sell the news type event. We'll see about that. You know, but to me, should a soft or no narrative or no landing narrative start gaining momentum, we could easily see a broader market rally and not just the mega caps, which have led the market in 2023. So the bottom line is in the last month or so, we've seen rates creep higher and stocks hold strong. Positioning short and bond traders are feeling max pain. If we rip higher, the smart guys will say that's because the dumb money is buying as they get slaughtered by sheep. Remember this in trading. There's only one way to keep score. Winners and losers in market are determined by wins and losses, not by the Ivy League degree on your wall or on my wall. There are no dumb winners or smart losers. Just winners and losers. And winners win. Take care, guys.